Hello and welcome. Today we're going to explore two fundamental concepts in the Philippine tax system: tax refunds and tax credits. These mechanisms are crucial for ensuring fairness, correcting overpayments, and incentivizing compliance. By the end of this video, you will be able to define and differentiate between a tax refund and a tax credit, identify the situations that give rise to them, and understand the process for claiming them. Our learning objectives are to define and differentiate tax refunds and tax credits, identify when they arise, and understand the claiming process. These concepts are governed by the National Internal Revenue Code, or NIRC, and have been further clarified by recent laws like the Train Law, Create Law, and the Ease of Paying Taxes Act. Let's start with the core definitions. Understanding these is key to differentiating the two. First, we have a tax refund. A tax refund is a return of excess taxes paid to the government, usually in cash. Think of it as getting your money back. If you paid more tax than you actually owed, the government gives you the difference back in cash. Next is a tax credit. A tax credit is a certificate or an offset that reduces your future tax liabilities. Instead of cash, you get a credit that you can use to pay other taxes you owe in the future. It's like a voucher for your taxes. So the main difference is the form of the benefit. A refund is cash in hand, while a credit is a reduction in future tax payments. Now let's look at the common situations that give rise to these refunds or credits. When do these mechanisms come into play? One of the most common scenarios is excess input VAT. This often happens in zero-rated transactions, like exports or services provided to non-residents. In these cases, the input tax you paid on your purchases exceeds the output tax you collected on your sales, and the excess input tax is not used. Since you can't pass on the VAT, you can claim it back. Another reason is erroneous or illegal collection. This occurs when a taxpayer pays a tax that was not actually due, perhaps due to a misclassification of a transaction or a double payment. If you can prove you paid a tax you didn't owe, you are entitled to get it back. The third situation is the cancellation of VAT registration. When a business retires or ceases operations, any unused input tax may be refunded or credited. This ensures that businesses are not left with unrecoverable tax payments when they close down. Finally, statutory incentives. Enterprises registered with investment promotion agencies like PEZA or BOI may claim refunds for qualified purchases as part of their tax incentives. These incentives are designed to encourage investment and economic growth. Let's now focus on the tax refund process. This is a formal procedure with specific legal bases and timelines. The legal basis for refunds is found in the NIRC. Section 112 covers refunds for zero-rated or effectively zero-rated sales, while Section 229 covers refunds for taxes erroneously or illegally collected. These sections are the foundation for any refund claim. The time frame for filing is critical. A claim must be filed within 2 years from the close of the taxable quarter, when the tax was paid or the sale occurred. Missing this 2-year deadline means you lose your right to the refund, so it's essential to file on time. Once you've filed, the Bureau of Internal Revenue, or BIR, has a processing timeline. They must act on your claim within 90 days of the complete submission of documents. This 90-day period is a strict deadline for the BIR. If the BIR denies your claim or fails to act within the 90 days, you have a right to appeal. You must appeal to the Court of Tax Appeals, or CTA, within 30 days from the receipt of the denial or the expiration of the 90-day period. This 30-day period is also strict. Failure to appeal on time will make the BIR's decision final. To support your refund claim, you'll need to submit a comprehensive set of documents. The BIR requires these to verify the validity of your claim. First, you'll need to fill out BIR Form No. 1914, which is the application for tax credits/refunds. This form is the official application for your refund. Second, you must provide VAT invoices and official receipts. These are crucial as they serve as proof of the input taxes you paid. The invoices and receipts must be VAT compliant, meaning they contain all the necessary information required by the BIR. Third, you'll need proof of payment. This could be bank statements, deposit slips, or other documents showing that you actually paid the taxes you are claiming. This confirms that the tax was indeed remitted to the government. Fourth, if your claim involves foreign currency proceeds, you'll need BSP documentation. This is to prove that the foreign currency was inwardly remitted and converted to pesos. This is particularly relevant for exporters. Finally, you'll need a notarized taxpayer attestation as required by RMC number 74-2024. This is a sworn statement from the taxpayer attesting to the truthfulness and completeness of the documents submitted. This attestation adds a layer of accountability to the refund process. Now let's shift our focus to tax credits. As we discussed, a tax credit is not cash, but a certificate that reduces future tax liabilities. The primary form of a tax credit is the Tax Credit Certificate, or TCC. This is a certificate issued by the BIR in lieu of a cash refund. A TCC can be used to offset various future tax liabilities, such as income tax, VAT, or excise tax. It's a versatile tool for managing your tax obligations. Under the CREATE law, a new type of credit was introduced, provisional TCCs. These are specifically for registered export enterprises. Provisional TCCs allow exporters to claim their credits more quickly, improving their cash flow and competitiveness. Another important concept is creditable input tax. Input VAT on purchases directly related to your VAT table sales is creditable against your output VAT. This is a fundamental part of the VAT system, preventing double taxation. You credit the VAT you paid on your inputs against the VAT you collected on your outputs. However, if your input tax is shared across both taxable and exempt activities, a ratable allocation applies. You can only credit the portion of the input tax that is attributable to your taxable sales. This ensures that you are not claiming credits for activities that are not subject to VAT. The interpretation of tax laws, especially regarding refunds, is often clarified by the courts. Let's look at a few key judicial rulings. A landmark case is CIR versus Aichi Forging. The Supreme Court ruled that strict compliance with the 120 plus 30-day rule is mandatory for VAT refund claims. This means you must wait for the BIR's 120-day period to expire before appealing to the CTA, and you must file that appeal within 30 days. Failure to do so is fatal to your claim. Another important case is Team Energy versus CIR. This ruling clarified the refund timelines for tax incentives under the CREATE law, providing more certainty for registered enterprises. This case helped to streamline the process for businesses enjoying tax incentives. Finally, in Taganito Mining versus CIR, the court allowed for documentary liberality in refund claims. This means that while documents are important, the court may consider other evidence if the primary documents are not perfectly compliant, as long as the substance of the claim is proven. This ruling provides some flexibility, but it's always best practice to ensure your documents are as compliant as possible. To help you navigate the refund and credit process, here are some practical tips. First, always maintain VAT-compliant invoices and receipts. These are your primary evidence for any refund or credit claim. Keep them organized and accessible. Without proper documentation, your claim is unlikely to succeed. Second, file refund claims early to avoid missing the 2-year deadline. Don't wait until the last minute, as gathering documents can take time. Procrastination can be costly in tax matters. Third, use eFast, the electronic filing and submission tool, for faster processing. The BIR is moving towards digitalization, and using their online platforms can significantly speed up your claim. This tool is designed to make the process more efficient. Finally, monitor the BIR's quarterly refund statistics for transparency. This can give you an idea of the BIR's performance in processing claims and help you manage your expectations. Staying informed is always a good strategy. Let's summarize what we've learned today by comparing tax refunds and tax credits side by side. For the form, a tax refund is cash returned to the taxpayer, while a tax credit is a certificate to offset future taxes. This is the most fundamental difference. Both are triggered by similar events, such as excess payment or zero-rated sales, or can be granted as an incentive. The underlying reason for the benefit is often the same. The deadline for filing is also the same for both, 2 years from the payment or sale. This deadline is non-negotiable. The processing differs. A refund involves a 90-day period for the BIR, followed by a potential appeal to the CTA. A credit is issued by the BIR and then applied to future dues. The refund process is generally more contentious and involves more steps. Finally, the BIR classifies refund claims by risk level, while credits may be provisional or final. This risk classification affects how quickly and thoroughly a refund claim is audited. Today, we have defined and differentiated tax refunds and tax credits, identified the situations that give rise to them, and understood the process for claiming them. We've seen that while both provide relief to taxpayers, they do so in different ways and through different procedures. Thank you for watching.